Do you have some money on the sideline? Are you waiting for that opportunity to invest, or are you simply paralyzed by analysis? Well, today's video is the first one of a series that will happen between January 1st and January 6th on how to invest a lump sum of money in 2024. Dividend Growth investors, bonjour, my name is Mike Yehu, and Happy New Year! I'm the founder of Dividend Stocks Rock, and I'm also the author behind this YouTube channel where I help you invest with more conviction so you can enjoy your retirement. And speaking of conviction, well, obviously, if you have money waiting on the sideline right now, you saw 22 happening, it was down, you thought, okay, so I'm going to wait a little bit more in 23, and then I'm going to deploy my cash. And then boom, 23 went back up, and now you're not too sure what's going to happen. Are we going to have a recession? Is the market crash is finally going to happen? You don't know what to do, right? So today I'm going to offer you the step one is why did I choose dividend growth stocks as my foundation in my portfolio. So obviously, when you're about to invest a big sum of money, what you fear the most is to invest exactly during that time. So that was what happened during the financial crisis of 2008. As you can see, the market went down and it took like 4 or 5 years to recover on both the S&P 500 or on the TSX. So there was no place to hide. It was a terrible moment. And if you have like a few $100,000 that you just invested like in May, June of 2008, well, you were in for a very long, wild ride. And then 5 years later, you're up by a few percentage, but you cannot retire on that, right? And this is what you fear the most. So then the reflex is you're going to tell yourself, well, I'm going to wait to get the good opportunity, right? So to get that opportunity and to get that conviction to invest, you're telling yourself, I'm going to wait and track some important economic metrics such as the GDP, the housing starts, the unemployment rate. I want to make sure that the economy is solid and moving. Well, here's what happened between 2008 and 2012. So long story short, the GDP took about 3 years to go back on an uptrend. During that time, the stock market was already up. The housing start continued to lag all the way down to 2011, 2012. So that was not even an indicator that would tell you to invest. Same thing with the unemployment rate. It started to go down slightly during 2011, and so we started the year of 2012 at 8.50% on the US side. On Canada, it was not any better. So imagine that you were in 2008 and then you give you a tap in the back, I didn't invest, I'm a genius. And then you wait 2009 and 10 and 11 and 12. And then you're still waiting. You're still waiting because the market now is higher up, but the numbers are just starting to increase a little bit, and you're still not too sure what's going to happen. And if you remember, in 2012, we were talking about a crisis in the Eurozone, the pigs with all those European countries having problems paying down their debts. We're talking about budget sequester in the US. It was not a good timing to invest, right? So better wait again. So instead of waiting like this, on my side, I decided to focus on dividend growers. Dividend growers that will show a very strong dividend triangle as the one you can see with Kushtar. And why? Well, because it gives me that level of conviction. Because when I invest in a dividend grower, I invest in a company that shows better sales almost every single year. So you look at a business and that business is increasing its sales because it has new products, it has great marketing, it has like iconic brands, it opens the market into new territories, it grows by acquisition. Like in summary, they always find a way to increase their sales. And then once they make more money, you want to make sure that they are also more profitable. So they have healthy margin, that they have an ability to generate cash flow, and that they can increase their profit year after year. Because it's one thing to make more sales, but it's even better if those sales translate into profit, right? So now you have companies that, regardless of what's happening on the market, they find ways to grow, they find ways to make money. And what's the result? Well, they share the wealth with shareholders, so they increase their dividend every single year. And here's the key: by focusing on dividend growers, you're not looking for companies just being a dividend. You're looking for the result of having a robust balance sheet, having a lot of cash flow coming in every quarter, and a thriving business model. All of that together will grow sales, grow profit, and obviously grow dividends. So the dividend growth is the result that you're looking for, not the source. It is the result, and that makes a big difference in your mindset. So you're sitting on a pile of cash for 2024, you're not too sure how to invest, and then I just told you, well, I would invest that into dividend growers, obviously, but then you start to do some research, and then you find out that a lot of people will tell you the opposite, and they will tell you, well, you should never consider just dividend paying stocks because you will lack of diversification, for example. Well, here's the result of my portfolio from DSR Pro. So DSR Pro is my platform where I manage all my portfolios, and now you can see the sector allocation. I invest in several sectors. You can see that I have like several companies inside my portfolio as well. So I don't think I suffer from any lack of diversification. Of course, this type of investment strategy will prevent me from investing in a company like Meta or Alphabet, but it will also prevent me from investing in a company like GameStop that just crashed and burned after some speculative plays. So the key here is you have to accept the pros and the cons of the strategy that you invest. If you want to go with index funds like ETF, that is fine too, because you have a maximum diversification, you don't pay too much in fees. But you must accept that you have a lot of companies in your portfolio. Some of them you may not like, but they're still there anyway. And when the market is down, it's really hard to understand why your portfolio is down. You just have to have a blind faith in the market and believe, oh, my ETF is going to do the job, but I don't know how it's going to do it. So this is why I rather select the stocks I have in my portfolio, so then I can monitor them and I can understand if they're doing great or they're doing not great, and why they are suffering on the stock market or why they are growing that fast. Another big advantage that you will have if you focus on dividend growers is that income coming in your account every single month. And why it's so important? Well, it's important to help you stay invested and stay the course. Right now, if you're sitting on a pile of cash, it's because you're paralyzed by analysis. It's because you are afraid to lose money. Well, when you have dividend in your account, it is a psychological impact where you feel a little bit better. You feel convinced that your strategy is working because the company is telling you every month, oh, here's some of my profit. So just a little reminder that your strategy is working and the business that you invest in is making money. What you can see here is every single month I'm getting dividends from a bunch of different companies. So each color is a different company. So my income is diversifying and the monies keep coming in every month, reminding me why I invest. And I think it's even more important to invest with conviction than to have the best strategy possible, because when you invest with conviction, you're less likely going to panic and sell when it's not the right time. And here's a great example of what you can focus on when you're a dividend growth investor. What you can see here is the dividend payment since 2007 from Fortis. And keep in mind, Fortis has been increasing its dividend for 50 consecutive years. On this graph, can you see the financial crisis? Can you see the bear market of 2018? Can you see the COVID? No, you can't, because the only thing you see is every single year your dividend income is increasing. This is a sign of confidence. This is a sign that the business is still doing well no matter what the market tells you. Now, if I pull out the stock market price of Fortis, you're going to see it going up and going down because it follows the market, and it's not a foolproof investment strategy. But what is great is when you feel in panic, you can go back to look at your portfolio, look at how much you made last year, the year before, and the year before. And then you look at this year and you're just like, hey, maybe my portfolio value is down, but my dividend income is higher. So that tells me that the strategy works, and that also tells me that I invested in companies that has enough liquidity, that has a robust balance sheet, and where management believes in their growth vectors for the future, and they can make that statement that they can afford to pay me more year after year. So if you are waiting on the sideline and you're not too sure how to invest in 2024, I'm inviting you to watch my webinar on how to invest in 2024. I'll do a full market review. I'm going to give you some stock ideas. We're going to talk about the main themes of 2024, and you'll be in a better position to shape your portfolio and to go through whatever happens in that year, because your guess is as good as mine. But what we're going to make sure together is that you are well prepared. So the link is just right there, dividendstocksrock.com/YouTube-webinar. It is 100% free. And if you registered and you cannot make it to the live event, you will receive the replay by email. So the webinar is on January 10th at 1 p.m. Eastern Time, and I always stick around for a good hour to answer all your questions. All right, so today we have determined that you should invest, and we have determined that also you should invest in dividend growth stocks. If it's an idea that you like, tomorrow we're going to talk about sectors. So until then, don't forget to stay invested.